Hello, everyone, and welcome back to the continuation of week 2. Now I'm talking about interest rate risk, which is part 2, as I promised you. Now, I already talked a little bit about interest rate risk, but now in this part, we'll talk about it in terms and in details, which means I want you please to take care of the modelings and how to measure that risk. We have two models, one model called the repricing model, the other one called the duration model. So we will go over them and we will go a little bit in deep for the interest rate risk. Now, if you allow me, please, I will share my screen, and this is around over 20 slides. Hopefully we'll just, okay. So this is part 2. And again, I will remind you with this, so we are talking today about this specific risk, interest rate risk, as part of our matrix risk, part of our matrix. So this is actually part 2. And let me start with the definition. We already defined it in part 1. Now we will define it a little bit here. So interest rate risk is the risk to earning and capital. And I want you to understand what we mean by earning and capital. So this is a risk to the income statement, and this is to the balance sheet, which means one to the capital and one to the net interest income. Now, how does it affect the earnings, which means the income statement, the bottom line, the net income? When market interest rate, for example, when market interest rate changes, what do you think, how well this affects actually the bank's net interest income? Take this example. We have net interest income, which is actually the interest income plus the interest expenses. So the interest actually income is interest receivable in loans, and the interest expenses is the interest payable on deposits or payable on loans. Now, the changes in the interest rates can lead to change in the net interest income, which means if the interest if the assets and liabilities actually not matching, and there is an increase in the interest rates, so I will increase my loans rates and I will increase my liability loans. That's fine. And in this case, I will be earning because my assets will earn more interest than I have to pay to my liabilities. But if the case is different and my liabilities is higher than my assets, I will have to, and the interest rate is increased by 1%. Yes, I will get 1% more from my assets, but 1%, but I will have to pay 1% more to my liabilities. But actually, my liabilities is higher than my assets. End of the day, I'm paying more than what I'm getting. The net impact on the income statement, or what we call the net interest income, is actually will represent losses. And this is what we call it, the impact on the net interest income and the risk to the earnings. So our earnings will decrease. Now, the capital should be, the impact on the capital should be very straightforward. Why? Because when we have investment, as I explained to you, and the interest rate, we have 100 million of bonds today and other securities that give me fixed income, and the interest rate increases, directly my assets will drop, because as I told you, the price of the asset is actually the cash flow over the income. So 1 plus I, which means, so this one actually, well, if this increase, If this is increases, as I said, now in this case, the price will go down. So if the I increases, as I explained before, the price will go down. And this is actually the impact of the increase in the interest income and in the capital, which means now, since my capital or equity is actually the difference between the market value of the assets and the market value of the liabilities, now the market value of the asset will drop, which means the market value of the liabilities will drop also, but if there is no matching, this will impact actually my net worth because of the increase in the interest income and the interest rate that will drop the market value of the assets and liabilities together. But if my assets is higher than my liabilities, I will end up losing in my equity. Okay, this is the whole thing. Now, let's go a little bit deep. Don't be, this is too much colors and all these things in this slide, but I meant it. I tried to make it like this. So just as easy as this. And this is very easy to explain. Assume I have a deposit. This is a liability, a deposit of 100 million. Fine. I receive it today. And today also, I gave a loan of 2 years from that deposit. And this is happening in banking. Now that is fine. As you can see, for the first year, I'm so happy because I'm receiving the deposit for 10% and receiving 12%, making 2% different out of the 2 million, which means I'm making 2 million. The problem is these people, the liability depositors, will come in year one and they want their money back. So there is 2 options here. Either I will ask them to increase it for 1 year, keep it for 1 year more, or I can get some other depositors, give me the 1 million, their 100 million, and I continue because their money is locked here. I can always get another deposits, or I can always rule over those deposits. Until now, everything is fine. The problem is, what if the interest rate increases? Now, when it increases, I cannot increase this one. It's fixed for 2 years. This is not a floating rate, it's a fixed rate. And it is, this is where the interest rate comes to the problem. The problem is when this is mature and they want to renew it, they will ask me for the new rate. Either the same depositor or any other depositor. We will have to have a new term and conditions, and we have to have a new contract. Now, assuming the next year will be 9%, this is here 10%, maybe the interest dropped to 9%, or maybe it stays, or maybe it goes to 11%. If I am here in 9%, I'm gaining actually, because I'm receiving now 3% for the second year. If I'm here 10%, then there is no problem because 10% and 10% still the same. The problem here, if I'm in case 3. If I'm in case 3, I'm exposed to interest rate risk, and this is coming from the refinancing. So it's interest rate risk coming from the refinancing, mean I'm looking for somebody to refinance. Now, let's look to the case from different perspective. The same 100 million, but this deposit man want to put it with me for 2 years. However, the business company wanted only for 1 year. Now, the second year, this guy will receive from me 10% fixed rate for 2 years. This guy, the borrower, will give me only 12% in first year. The second year, we will have to have a new term and conditions, which means the rate could be 11%. Now, 11% is a problem. Why? Because I used to have it 12%, now it's 11%, which means there will be 1% decrease in my net interest income. I still gaining, but there is 1% drop from this year to this year. Here also, maybe it's 12%, there is no difference, Or maybe it is 13%. Now, if it is 13%, I'm so happy because now I'm making 3% more, which means there is no risk here. There is no risk here, the risk is here. Similarly, likewise, there is no risk here. There is no risk here, but there is a risk here. So please understand this issue. So this is what we call refinancing risk. If we reverse it, we call it reinvestment risk, which means I want to reinvest my assets and hopefully my money, and hopefully I will find a borrower, or the market will allow me to give in 13 or 12. If the interest rates goes down, it's a problem. Here, if the interest rates goes up, is a problem. Anyways, this is reinvestment risk, and this is refinancing risk. I want to take this one and make it in a table, which means if you understand the concept, we will be just very, we can talk about it very easy. Now, look at this. This is the situation. This is, let me just, this is the current situation. Here is the current situation, which means I have interest income of 100 million and I have interest expenses. I have 1 million, the loan is 100 million, which is the same thing. All of this is the same. 1 million, 100 million, 100 million. This is for the second, for year one. This is for year one, no problem. Which means in year one, I got, as you can see, I got, in year one, I get 2,000, 2 million actually, and I'm happy with that. Now, what would happen in the second year? In the second year, we are talking now about the deposit. We are talking about the deposit, this case for the deposit, which is the refinancing risk. Now, the second year, it could be drop. And in this case, as you can see, I will make 3,000, which means now I will pay only 9 million and receive 12 million. I get 3 million. While in the first year, I used to have 2 million. So is there a difference between that? Because I'm looking for the change in the net interest income. The change in the net interest income is green. I'm happy. Let's go to case 2. This is all in year 2. This is all in year 2. Year 2, the case 2, because I have 3 cases, either 9 or 10 or 11. So because this is fixed, 12%, 12%, 12%. The loan is for 2 years. It's just the deposit doesn't change. So when it changes to 10%, actually no difference for me, no difference, because I will take, this is what I will get. I used to get for the first 12,000 to 2 million. So the impact is 0. I'm indifferent. Now in the third case, I'm only getting now 1 million. I used to get 2 million. There is a drop in my net interest income of 1 million, which means the change in net interest income is 1 million. This is my risk, which I call it refinancing risk. Now let's talk about case 2, which is actually similar of what we say. So in case 1, for example, as I told you, my risk is here. My risk is actually in this place, is in this area, in this box. It's not here, it's not here. So you can see all of this can cover, it's only this box, okay, which shows. Anyways, I don't think it's a difficult issue to understand. It's very simple, it's very straightforward. Let's go and do the same thing here, and let's look at here. So this is the first year, as I told you, I'm getting 2,000. But now what is fixed is actually my deposit. Now I'm having a deposit for 2 years and a loan for 1 year. So deposit, I will pay 10% the first year, 10% the second year, under the 3 cases. I always pay 2% in the second year because it's a fixed for 2 years. The loan, the problem when the loan finish in the first year, it can be 2% to 12%, which means there is no problem here. There is no impact. Or it could be 13%, which means in this case, I used to have the interest income will be 13,000, and I still pay 10,000, which is I make 2,000 difference, which means 3,000. I used to make only 2,000. Now I have, as you can see, 1,000 green. I'm happy, even happier than the first year. Here is the problem where the loans is only now paying 11%. So I get 11 million. I pay for the second year is, this is 100. I get 11 million interest. I pay 10 million. So in this case, I am getting only 1 million. So the difference, I used to have 2 billion. So the difference is 1, and this is what we call reinvestment risk. Having said that, I think if we know it, this is usually a very important issue to know it. It's very straightforward, but it's easy.